I've reminded you guys, for those people who are not there, I've reminded you on how we did computation of goodwill. Under purchase consideration paid in two ways. First part paid in cash, the second part in that share exchange. Now, after that, we know we normally add fair value of NCI at acquisition. And that figure was given under additional information number 1. Below there, you are told the fair value of non-controlling interest in Kesha Limited as at the date of acquisition was 340 million. So we brought on board 340 million as the fair value of NCI. Then we added to the total purchase consideration. Then we compare that with the net assets acquired. Where do we get the net assets acquired? It was also given in note 1, where we were told the fair value of identifiable net assets in Kesho at the date of acquisition. We were given there PPE, inventory, trade receivables, cash and cash equivalent, trade payables, and current tax. And the net figure is 1,310. You can see that figure. So that is the net figure that we are picking there as the net value of the net assets of the subsidiary at acquisition. So that's where we brought in the 1310. But because we are lessing, we brought it in as a negative, and we got the net effect as 510. We add total purchase consideration, we add the fair value of NCI at acquisition, then we deduct the value of net assets at the date of acquisition. So we got goodwill at acquisition of 510 million. Now, how do we know whether this goodwill was impaired or not? You go back to the statement of financial position provided and you realize we were given the opening amount of goodwill, which is 1160 here, then the closing amount of goodwill, which is 1540. So to get to see if that goodwill was impaired or not, that goodwill at acquisition, we are going to add it onto the balance brought down of goodwill, the opening balance of 1160. Then we see what is the total that we're going to get, and we compare that with this closing balance of goodwill at the end of the current financial year to see if there was a reduction in value or not. So we went ahead and brought in that information. So balance brought down is 1160. You've seen that. Then we are adding the goodwill at acquisition, which is 510. We've just computed it. Then we see what was the expected closing balance. What was the expected closing balance? But before we do that, there was an information given in note 5 about summary translation laws. Can you see note 5? We were told there was some movement in exchange reserve, which are losses related to retranslation of these assets that were acquired. Yeah, so we acquired these assets and there were some losses that were incurred in that retranslation. And PPE was one of them, affected by 210 million. Goodwill was affected by 45 million. Inventory was affected by 60 million. Trade receivables was affected by 80 million. Trade payables, we got a relief of 70 million. And then current tax also was reduced by 25 million. And remember, there was these positives and negative signs should not mislead you, should not confuse you. Any reduction in the value, any loss you incur in an asset, yeah, any loss in an asset is a reduction in its value. Then any loss in a liability, is actually a gain to you. If you lose a liability, if you incur any loss in a liability, that is a gain. If you incur any loss in an asset, that is a loss on your side. Yeah, any reduction in value is a loss. Any reduction in value in a liability is a gain. That's why you see these liabilities, trade payables and current tax, are given in positive because they are gains. If you owe someone 100 shillings today, then tomorrow, the amount you owe this person goes down to, for example, you now owe the person 50 shillings. That reduction in that your liability is a gain to you. But if the value of your asset is 210 million today, then tomorrow it goes down to, for example, 200 million. You have lost in that value by 10 million. So that is why they've brought in these assets as negative, then the liabilities as positive. Now, we brought in the element of inventory reduction in value in goodwill, in goodwill here. Goodwill lost 45 million. So in our goodwill that we've computed, we have to also reduce it by that loss of 45 million. That's why you brought in negative 45 there. Then now that gives us the expected closing balance. We expected this closing balance to be this figure of 1,625. But if you go to the statement of financial position, what is the closing figure given there? In the statement of financial position, we are given the closing balance of goodwill at the end of this year as 1540. So what has happened? If we expected it to close at 1625, but we are being given that it is closing at 1540, what has happened? The figure has gone down from 1625, which we expected, and now we have 1540. The reduction in value of goodwill is what we call impairment. That's how we came up with the value of impairment, by getting the difference between 1625, which we expected, and what we actually have as the current value, net book value of that goodwill, 1540. The difference is 85. So 85 million is the impairment on that goodwill. That impairment on that goodwill, we brought it in here as an adjustment under non-cash items. Because that impairment of goodwill was charged in the income statement as an expense. So we are adding it back to correct our profits. I just want to believe that those who are not there in the last session, you have gotten that concept. There was Lucian, and there was also another great man here. I can't remember the name. Was it Victor or somebody? Who are not there in the previous session. I just want to hope you've catched up already. You have gotten that concept. Good, good, good. Diana has gotten it. Good. Now, after doing that adjustment for impairment, you can see the elements that we listed before below it there. We have loss on disposal of PPE, amortization, gain on disposal of PPE. And if we look at our additional informations, I want us to look at the additional informations here. We've already dealt with additional information. Number one was just about acquisition. And we've used it to get our impairment in goodwill, impairment loss in goodwill. Now, additional information number two, we were given depreciation, which we've already picked. We've already picked that depreciation charge and put it under adjustment for non-cash items. We've added it back. Now, let's look at additional information number three and see what are they bringing on board. Now, during the year ended 31st December 2023, Bustani Limited revalued its property for a gain of 360 million. So there was a revaluation gain. And then we are told Bustani Limited does not make an inter-reserve transfer for the excess depreciation upon revaluation. Yeah. So if this Bustani Limited revalued its property for a gain of 360 million, that revaluation gain, and remember, out of the elements, the adjustments for non-cash items under cash flow from operating activities, there is gain or loss. There is gain or loss on disposal of PPE. But remember, this one is revaluation being given in note 3. It is revaluation, gain on revaluation. I want you to look at that, gain on revaluation of PPE. And it is how much? PPE has been revalued upwards by how much? 360 million, yes. Gain on revaluation. Now, how do we handle gain of? We know very well that PPE is affected by revaluation. PPE is affected by depreciation, and PPE is also affected if you maybe purchase more of the PPE items. So, under these elements here, we are not bringing on board the gain on revaluation here. We are going to use that gain on revaluation in note 3 to get to see how much PPE was purchased, if there was any purchase in PPE. We are going to see that under this section of cash flow from investing activities. So let's just keep that note 3 for now, because we are looking at these elements that we are adjusting as non-cash items. So let's go to note number 4. To note number 4, we've read note 3 and it's about revaluation. We are going to see how to use it. Note number 4, we are told the group policy is to measure non-controlling interest in all subsidiaries, including the foreign subsidiary, at their fair value at acquisition date. So that's okay. That's an additional information, which is okay. We've already used that group policy in computation of goodwill. Note 5, we are told about movement in exchange reserve losses. This is about retranslation loss. You remember we picked the one for goodwill. So PPE was also affected. Inventory was also affected. Receivables, payables, and tax were also affected. We are going to take into consideration those ones. Note number 6, ignore deferred tax consequences on the acquisition of the subsidiary and on the revaluation of property. You know very well that note number 4, note number 3, talking about revaluation, if there is any revaluation happening, normally affects, yeah, revaluation happening, there is normally the element of depreciation charge. And if the examiner tells you about deferred tax on that revaluation or on acquisition, we need to be able to consider it, but they've told us to ignore any of those deferred tax consequences on that. Now, let's go and look at those items that we can pick directly from the income statement and put under the adjustments for non-cash items. Now, I want you to look at these other elements, which you should not even fail to pick. Finance cost. Finance cost. If you go to the income statement, you realize that finance cost was charged as an expense. You can see it was deducted as an expense, but it does not necessarily mean that finance cost was paid. We are going to narrow down and see if any part of that finance cost was paid and to what extent. That computation is coming shortly after we've done the adjustments for working capital. You see that section of cash flow. After adjusting the working capital, we bring on board amount of tax paid and also finance cost paid. Now, on the finance cost paid, you can either handle this finance cost paid at this level under operating activities, or finance cost paid, you can as well handle it under financing activities. No one will penalize you for treating or maybe for handling finance cost under financial activities or under operating activities. But for me, I would prefer to use it at this point. But there is no harm if you take it to financing activities. IAS 7 under cash flow statements is not very specific that you must use it under this category or under this category. So we are at liberty to use it adjust it under operating activities to get the finance cost paid, or take it to financing activities section and include that finance cost paid. You'll still be good. No one will penalize you for that. So finance cost which was charged in the income statement was 160 million. And because it was deducted as an expense, we are adding it back. We are recognizing it back to correct our profits. Then in the income statement, there was also some element of income that was recognized. You see the share of profit of joint venture, the 240 million, it was recognized as an income. It was a share of profit. That's why it was given as a positive. It was added. So it overcasted our profits. Our profits were overcasted by 240 million. So to correct our profit before tax, we must now deduct it. That's why you see 240 you brought in as a negative. It was added. Now we are doing the reverse. We are correcting that entry. You see, that's why we brought in as a negative 240. So that's what we did. And that marks the end of the adjustments for non-cash items that we had in the income statement. And also we've gone through the additional informations. So we move to the next section. And which next section is it? The adjustments for working capital elements. Now, under this section, I do not expect anybody to fail anything under these working capital elements. Why? Because the formula I gave you there, the approach I gave you there is very direct and easy. Just take under all the assets, under working capital section, all the assets, just take the opening amount, add whatever amount you've acquired from the subsidiary. Because we know we have acquisition here in note 1. There was an acquisition of this subsidiary. Any element of asset, current asset here, any current assets you acquired from the subsidiary, you must add it to the opening balance. when you want to get the adjustments for working capital elements. After you've added whatever you acquired from the subsidiary, then you also make sure you deduct any retranslation loss, note 5. You see note 5 given there? There were some retranslation losses. So because you are dealing with current asset and current liability elements, check on any loss that affected any current asset and liability items. You can see inventories here. This is a current asset element. It was affected with a loss of 60 million. Receivables was affected with a loss of 80 million. Payables and current tax were also affected. These are current asset elements, current liability elements. So whenever you're doing these adjustments, make sure you don't forget to deduct the loss on retranslation. So opening balance, add the element acquired, the current asset acquired in the subsidiary. And then you less or you deduct the loss on retranslation. After that, you compare that with the closing balance. So the logic here is just take the opening amount minus the closing. But remember, this opening amount, it has to be adjusted where necessary. The adjustments that you put in here depend on how the question is framed. Yeah? The adjustments that you put in here depends on how the question is framed. And in this case, the adjustments we've done is to recognize amount on acquisition. You've acquired your subsidiary. If there are any elements of current assets there, please make sure you add it. Another adjustment which we brought in is the loss on retranslation. It does not mean they will always be there. These adjustments depend on how the examiner brings the question. But in most cases, just remember, it is opening minus the closing balances. And once you go that way, if you get a positive or a negative, do not even bother yourself. Don't even disturb your mind asking yourself whether it's an inflow or an outflow. Leave the figure as it is if you follow this approach. Because inventory and trade receivables are both assets, it is opening minus closing. Opening minus closing. That is always the trend. Adjustments that you give there depend on how the question is framed. And in this case, you recognize what has been acquired and also you deduct the loss, any loss that has accrued on retranslation, compare with the closing, and there you go. So we got the 220 for inventory and we got 60 on trade receivables, following the same procedure. And you can see, if I activate that formula, you can see the adjustments that we did. Then, when you come to the current liability elements, when doing adjustments under the working capital section, the liabilities now you do the opposite. Instead of starting with opening and closing, which we've done in assets, now you reverse and you say, now it is closing, you are comparing with the opening balance. And remember, whatever we are adjusting is the opening amount. We do not adjust the closing amount. Closing amount is the final figure, the final balance closing that account. We are only adjusting the opening. So if you follow closing minus opening, now it is the opening that will be adjusted. You will adjust the opening amount. The opening amount is what you will adjust in that case. So we picked the closing amount of payables, which in this our case was closing amount of payables is the closing amount under the current year 2023. And you can see trade payables closing amount is 1,600. Now that is what we compared with the opening balance, which was 1690, and we make sure we take care of the adjustments. Which adjustments are they? How much of payables did we acquire from the subsidiary? Note 1. Payables acquired from the subsidiary was 210. That's why we added 210 in this my formula here. Then we make sure we deduct any retranslation losses on it. Note number 5. Which loss was it? Trade payables suffered a loss of 70 million. That's why we deducted 70 million again. So that's how we've gotten, after adjusting all that, we compare with that closing balance, then we realize that we have an outflow of 230. You do not have to bring in explanations on why it is an outflow or an inflow. In an exam room, we don't have that time. Now it's coming like that. If you follow that concept, you don't have to worry, leave it as that. You are good and you're correct. Good. So I hope we are all good under adjustments for working capital elements. Is there someone having an issue there? Before I come to tax paid and finance cost paid, because that is the next thing I want us to tackle. Is there anyone having an issue? I hope we are all good. Are we all okay? I just want a confirmation. Are we all good up to that point? Are we all good up to that point? Remember, I don't intend to cover another cash flow statement question after this because we've already done a lot of them. So I just want to make sure to confirm that we are all good. Good. I can see members are okay. Good. So having understood it up to that point, let's now come to these two elements. How do we compute tax paid? And how do we compute finance cost paid? Those are the two things. And I want to give you the easiest approaches without having to go to the T accounts. Now, whenever you talk about tax paid, I want us to check something from tax paid. Let us go to the income statement and see something there. In the income statement, we were given income tax expense for the year. You see how much it was? They charged 220 million as an expense there. That was the income tax charge for the year. What are we looking at? We want to see, out of this tax charged, was there any tax paid for the year? This was charged, but was there any tax amounts paid during the year? We do not know until we check if there are any accrued, any deferred taxes in the statement of financial position. So let's go to the statement of financial position. Under non-current liabilities and current liabilities section, because you know deferred tax is a non-current liability item. So if I look at non-current liability section, I can be able to see there was a deferred tax. And you see what? Deferred tax has an opening balance and a closing balance. And again, there is current tax under current liabilities, current tax. Yeah, 470 opening, 610 closing. Now, how do we bring together these deferred tax elements and current tax elements, and we compare again with the current tax charge, income tax charge for the year, so that we get to ask ourselves if any tax was paid or not paid? It is very simple. Deferred tax was just a tax that was postponed from the previous periods. Current tax is the tax for the current year, tax balances for the current year. Amount that opened the current year and the amount that is closing the current year. So we treat them together. These are brothers. You see, current tax and deferred tax are brothers. So if you draw up a tax account, which I want us to avoid drawing the T account, we have to make sure we go with them hand in hand. The opening balance in taxation account, in tax account, we will pick the opening balance of deferred tax. We add the opening balance of current tax. We are treating them together because they are the same thing. Deferred tax was tax postponed from previous periods. Current tax is the tax for the current year, opening and closing balances. So let's write those adjustments. Let me give you the adjustments that you're going to do here. Now, when you talk about tax paid, and remember that tax is a liability. Finance cost is a liability. And what I've given, do you remember what I've given you up here about the adjustments that we're supposed to do when doing working capital adjustments? You remember what I've given you there? Now, that already should inform you about something, When we talk about tax being a liability and finance cost being a liability, I want us to take this approach. Closing balance, compare with opening balance plus adjustments. You see that? Now, here, let me just give you that formula here. So what you're going to do is very simple. To get the tax paid, so that you do not worry about an inflow or an outflow, but obviously because it is paid, it will come as an outflow. Take the closing balance. Take the closing balance of that tax in the tax account under the liability section in the statement of financial position. Then you compare that with the opening balance. And remember, opening balance is for both current tax and deferred tax. Is someone saying something? All right, I think that was by mistake. Now, the opening balance is what we adjust. And when we are adjusting the opening balance in that tax account, make sure, because there is an acquisition, let us look at note 1. Was there any tax which was acquired? You can see the fair value of identifiable net assets. I can be able to pinpoint there was current tax acquired from this subsidiary of how much? 40 million. You see that? That one affects our tax account. So, opening balance, add, tax acquired, from the subsidiary. You add it because it is affecting our tax account. We are bringing on board more liabilities. After you've added that tax acquired from the subsidiary, make sure you check if there were any retranslation losses that affected tax, any tax element, either deferred or current. Let's go to note 5. There was current tax affected by how much? 25. It suffered a loss of 25, right? There was a loss, retranslation loss of 25. But I mentioned to you, this is a liability. Any loss on a liability is a gain on your end. Any loss on a liability is a gain on your end. So that 40, this 40, is it 40 or 25? This 25, under the retranslation losses, this 25 is going to affect our opening balances of this tax. So tax acquired, we've already added to the opening balance. Then we are coming to the exchange loss, retranslation loss. But before we go there, I want us to recognize the tax which was charged during the year in the income statement. Where is it? There was tax charged for the year. Let us not forget it. I was almost forgetting it. The tax which was charged during the year was 220. So we have to add tax charge for the year. Tax charge for the year, tax charge for the year, or tax for the year, tax for the year. After we've added tax for the year that was charged, then we now take care of the retranslation loss. Any retranslation loss, now we go there and say retranslation loss, or let me just call it loss. We take care of the loss. We compare the whole of that with the opening balance of tax. With that kind of approach, with this approach, you are able to get directly the amount of tax that was paid. Let me highlight it in red like that. So let's follow that and get our tax which was paid during the year. So I will come here, start with the closing balance because this is a liability. Where do we get closing balances? We get them from the statement of financial position. So let's go there. Under the current and non-current liabilities, because I told you deferred tax and current tax, they are elements under tax. They are all elements of tax. So let's pick the closing balance of in the deferred tax account under non-current liabilities, which is the closing balance. Closing balance is the balance in the current year, this 990. Now, 990, then we add closing balance for current tax. Where is it? 610. Now, those are the closing balances. Now we introduce a bracket, so because these ones are the closing balances. After that, we compare the closing balances with the opening balances. So I will go and open another bracket for the opening balances plus adjustments. So what is the opening balance of tax? We pick again the opening balance of the current tax from the previous year and deferred tax from the previous year. So I will pick deferred tax opening balance, which is 1020. Then I'm adding opening balance of current tax, which is 470. Now, those are just opening balances. So we've just taken closing minus opening, but opening balances has adjustments. Which adjustments are they? I will go to and add any liabilities we acquired from the subsidiary. Where is it? Note 1. Current tax was 40. So we acquired more liability of 40. We add. Then we add again any income, any tax expense charged for the year. Income tax for the year, charged for the year. Where is it? In the income statement. Where do we get it? Here. It is 220. So we go ahead and add 220. But then, this liability was reduced by the loss. Yeah? The liability was reduced by the loss. Loss of how much? Note 5. Note 5, we were given this retranslation loss of how much? 25. So we come and recognize that 25 like that. These are all the adjustments we're supposed to do under tax. I close that bracket and compare the two. Closing balances and then opening plus adjustments. This is a liability account. Now, that should give us tax paid. Where is it? I'm getting negative 125, like that. Negative 125. That negative means it is an outflow. We do the same for finance cost paid. We do the same for finance cost paid. Now, finance cost paid, we follow the same trend. Nothing different. Now, to follow that trend of finance cost paid, we also do the same. We are just going to take the closing balance of the finance cost paid. Then this closing balance, we are going to compare it with the opening balance plus adjustments. Which adjustments are they? We're going to see if there was any finance cost acquired from the subsidiary. So, subsidiary acquired, we're going to add any finance cost as a liability, subsidiary. I'm just trying to shorten my words, subsidiary acquired, like that. After bringing on board the liability acquired and as a finance cost from the subsidiary, we are going ahead. Is someone speaking?
Yes.
Yes?
Could you kindly repeat your tax paid? I'm getting a different figure.
You are getting a different figure.
Yes.
What are you getting?
I'm getting 75.
All right. So did you do all the adjustments required in the opening balance? Did you recognize the 40 which was acquired from the subsidiary? Make sure that your opening balance, let it be opening balance of both current tax and deferred tax. And the opening balances are the balances from the previous year. They are the balances opening the current year. So for opening balance, add 470 plus 1020. That is those are the opening balances. And then closing balances, also make sure you pick the two, the one in deferred tax and current tax. And you follow this procedure that I've given here. Yeah. So have you considered opening and closing, adding both of them? Becky, I think that was Becky, before we go to the adjustments. Did you do those?
Yeah, that is what I've done. I have done, let me check. I've done opening of yes. Is it opening? Closing, opening of deferred tax plus closing or opening of current tax minus, I know I'm wrong.
Oh, you've seen where you went wrong. Okay. All right.
Yes.
All right. Good. I think that's okay now. That's okay now. So let's go ahead and now get finance cost paid. It is the same approach. Closing balance, we compare with opening balance. We add whatever we got from the subsidiary. Then after adding what we got from the subsidiary, let's see what was the finance cost charge in the income statement. Yeah, we go to the income statement and ask ourselves any finance cost which was charged, and it was given. Let's see. Let's see our income statement. You will see finance cost was given here, 160, which was charged for the current year. We are going to add it. So let's just say income statement or charge for the year. We are going to add that. Then after you've brought in the charge for the year, then we also recognize and deduct the retranslation losses, any retranslation loss on that finance cost. So let's go ahead and do that again. So we are starting with the closing balance because it's a liability. A liability, you compare closing and the opening plus the adjustment. So we go ahead. Let's pick the closing balance. Where do we get it? Closing balance of liability, we get it from the statement of financial position. And the liability we are talking about here is finance cost. So I want us to go to the liability section, and see if there was any liability which closed the year. Now, under current liabilities, this is where we should have interest payable or finance cost payable. But I'm not seeing finance cost payable. What does that mean? We do not have any liability closing the current year under finance cost. There was no finance cost closing the year. So it is zero. This zero, which is the closing balance, we are comparing it with the opening balance plus adjustments. Now, what is the opening balance? If we do not have that element in the statement of financial position, then it means even opening balance is zero. We do not have any balance of that liability called finance cost or interest expense payable. We do not have the opening balance. So opening is also zero. I believe we are seeing the trend. Then let's see if we acquired any finance cost, any interest expense, any interest, any liability under interest payable from the subsidiary acquired. From the elements given here in note 1, I'm not able to see any finance cost or any interest expense that we acquired. We did not acquire any liability under the finance cost or interest. So we also acquired zero. Then after that, we go ahead and see, was there any interest expense charge, any finance cost charged in the income statement? I will go and see if there was any interest expense charge for the year or finance cost charged. And I can see there was 160. We come and add it because that was a charge for the year. It increases our liability. Then we go to note 5 and check, was there any retranslation loss affecting our finance cost or interest expense, interest payable? Let's go to note 5. I'm not able to see any interest payable or finance cost payable. So it was not affected by any retranslation loss. So we also deduct zero. There was no loss on it. I close my bracket and hit on enter to see what finance cost did we pay. It is 160. So the whole amount which was charged in our income statement was actually paid because we do not have any closing liability on the same. We did not acquire any from the subsidiary and there was no retranslation loss affecting that our finance cost. So the finance cost which was charged was fully paid. That's how we get finance cost paid. So that adjustment, if you follow this matrix, you will always get it correct. Then that will finalize our cash flows from operating activities. So let's get the cash flows before adjustment for working capital. We were supposed to get the figure here. But you know, in an exam, examiners do not mark these totals. They mark the entries. They mark the entries only. So we have cash flows before adjustment for working capital there. Then we brought in the working capital adjustments. Here they are. And then we get cash flow after adjustment for working capital. So we can just go ahead and get it. So from after taking care of adjustments, we have that. Then tax paid, we've computed. Finance cost paid, we've computed. So what is our net cash flow from operating activities? What is our net cash flows from operating activities? We are coming here and we pick, let me just come here. So our net cash flows from operating activities is cash flow after adjustment for working capital. Then we knock off tax paid and then finance cost paid. That gives us the net cash flow from operating activities. And in my case, I'm getting 820. I think I need even to put it on this other cell here, this other total side. Yes, that is the net cash flow from operating activities. Now let's move to the next part of cash flows from investing activities. These investing activities, these are activities that involve huge capital investments and they normally touch on non-current assets, PPE elements. They touch on PPE elements where we ask ourselves, was there any purchase of PPE? Was there any acquisition of the subsidiary or the purchase of a subsidiary? Note 1 already tells us there was. You can see there was an acquisition of a subsidiary there. That falls under investing activities. Then we see if there was any disposal of any PPE element. And again, this subsidiary which was acquired, was it also disposed? What are the proceeds when it was disposed? What did we get in return? Then, did we receive any dividends? That is an investing activities. Was there any investment income which was recognized in the income statement? Those ones, we come and bring them under cash flow from investing activities. So, very fast, let's go to the non-current asset section and see any movements in our PPE elements. I want us to see any movements in our PPE elements there. Now, if you look at the statement of financial position here, we can see PPE. Opening balance was 5180, closing is 7510. What does that tell us? And again, PPE elements on acquisition, you can see there was also PPE elements acquired. There was revaluation in note 3. I hope you remember this. There was a revaluation of some property by 360 million. That affects PPE. Retranslation loss also affects PPE. So let us bring all those into consideration so that we get to see if there were any PPE elements that were acquired or not. How do we do that? We want to open that PPE account, but we can avoid opening a T account, or we can still go ahead and open it. I like going through this approach of avoiding T account. Let me call this working number what? Working 2. Let me call it working 2. Let me call it working 2 like that. Where did it disappear to? Where did that disappear to? All right. Let me call it PPE. PPE account. Let me just call it PPE account. Now, when you talk about the PPE account here, it is very simple. Just start with the opening balance. Opening balance. What is the opening balance in the PPE account? Opening balance in the PPE account. We pick the opening balance from the statement of financial position. Opening balance from the statement of financial position. And the opening balance is the closing for the previous year, 5180. I bring 5180 on board like that. Then elements affecting PPE. On acquisition, if you acquire any PPE element, it will increase your PPE account. This is an asset account. Any additions is debited. So we come here and say, add PPE on acquisition. What did we acquire? What amount of PPE did we acquire? We go to note number 1 and we see the amount of the value of PPE acquired was 820. So we come there and add 820 million. Our figures are in millions, so don't forget that. Our figures are in millions like that. So after bringing on board any additions of PPE that we acquired, we again ask ourselves, what is going to affect this our PPE? We check note number 5 to see if there was any retranslation loss on acquisition. We've already recognized what we acquired, right? So was there any translation loss on that acquisition? Yes, there was. PPE was affected by how much? 210 million. There was a loss on the value of PPE. So we come to this our asset account and recognize that loss. We say less retranslation loss. So which retranslation loss are we talking about? The figure was given there as 210, if I'm not wrong. Let me just confirm. Note 5, 210, yes, 210 like that. That is the retranslation loss. We are deducting it because it will reduce the value of our PPE. And you know, any reduction, if you're drawing a T account, this is on the credit side. These ones opening and what we got from acquisition are on the debit side. Another thing that is affecting PPE is note number 3. Note number 3, we were told about what? Revaluation. During the year, we were told Bustan Limited revalued this property by a gain of what? 360 million. So that revaluation is going to affect the value of our PPE, right? Now, if it affects the value of our PPE, we come here and adjust our PPE by revaluation. And you know this is an upward revaluation, so we are going to add revaluation. That revaluation is how much? It was revalued by 360 million. Note number 3. We were told it was revalued by 360 million. So that's a gain, revaluation gain. Now, after recognizing that revaluation, is there something else we are leaving out? Yes. Depreciation. Depreciation normally affects the value of our PPE negatively. It reduces the value of our PPE. Where do we get depreciation? Depreciation was given in note what? In note number 2. You can see the depreciation, 310 million. So we have everything we need. So 310 like that. And depreciation normally affects, so it should come in as a negative. It reduces the value of our PPE like that. With all that, I think we need to get the net effect and see what is the expected closing balance of PPE. We expect the PPE account to close at that figure of 5840. But what is the actual balance carried down? balance carried down in the PPE account. We get it from the statement of financial position. We were given the closing balance of the PPE account. How much was it? PPE was closed at 75.10. You see that? So we expected, after getting the opening balance and doing all these adjustments, we expect the value, the closing balance of PPE to be 58.40. But that is not the case. The closing is 75.10. What must have happened? If we expected to close at 5,840, but is closing at a higher value, we must have purchased, we must have brought in more PPE. And that's where we are getting purchase or acquisition. You can use any term. Are you either acquiring or purchasing? It is the same thing. The purchase or acquisition of PPE, the amount spent to acquire that PPE elements, it is the closing, what is the actual balance, and what we expected it to be. And we can see the purchase amount is 16 what? 1670. So that's what we take and bring to our cash flow statement under investing activities. And we say purchase of PPE, it is an outflow. When you buy, you spend. When you buy, you spend. It is 1670, like that. Then remember, we have acquired a subsidiary. In the computation of our goodwill here, we acquired our subsidiary in 2 steps. Step 1, we paid cash. Step 2, we did a share exchange. This cash which was spent here, it is an outflow. We went to our bank and paid 880 million. We recognize it under investing activities. Where is it? Purchase of subsidiary. How much did we spend? 810. We spent 880. But remember, it is 880 what we acquired from the subsidiary. I want us to look at the elements, everything that we acquired from the subsidiary. What do you think happens when you acquire a subsidiary by paying 880 million, but then you realize they have 70 shillings in their bank account, 70 million in their bank account? You pay 880 and you get back 70 million. So how much have you really spent? You've spent 880 less 70, because 70 million is coming back to you. So the amount we've spent here is now 810, because it is the 880. Let me just introduce a bracket here. We've spent 880, but then we are getting back 70 million. So the actual amount that we've spent, that has gone out, is 810, right? I hope we've gotten that. Good. Yeah. So I can see someone is saying we avoid T accounts, which I also agree. Let's avoid it. Now, that is the amount we've spent to acquire the subsidiary. Let's look at these other elements. Did we have any disposal of PPE or disposal of subsidiary? I did not see if we disposed our subsidiary from the additional informations. There was nowhere we were told there was any PPE disposed. No, we only acquired in note 1. Note 2 was just about, depreciation. Note 3 was revaluation. Note 4, we are being told how to value NCI. Note 5 is about retranslation losses. So there was nowhere we were told whether there was a disposal of PPE or subsidiary. So those ones are not there. We go to the next one. Were there any dividends received? Any dividends received? Let's check our income statement. If we received any dividends from the income statement, where is it? Let's see, revenue, gross profit, and that. Income tax for the year. I want you to look at the section of other comprehensive income. There was gain on revaluation, loss on retranslation. There was profit for the year. There was attributable to the owners and attributable to NCI. Then we have again total comprehensive income for the year. So I want you to look at these elements very carefully. If we want to see whether there was dividends received, is it dividends received or dividend paid? We are looking at the cash flow from investing activities. Under investing activities, we check if we received any dividend, because dividend is a finance cost if we pay. But here we are looking at investing activities. We check if we received any dividends. So to see if we received any dividends, I want us to look at the statement of financial position under our joint venture, the interest we have in our joint venture. Where is it? I want you to look at interest in joint venture line. You see that interest in joint venture? That interest in joint venture line is going to inform us whether we received any dividends from that our investment or we did not receive. Yeah, we're going to see if we received any dividends or we did not receive. And we are going to compare that with our share of profit. You see, the interest in joint venture, there is an opening and closing balance. In the income statement, there is a share of profit which we received. You see that? Share of profit of joint venture, 240. But then we've been given opening and closing balance of our interest. So how do we compare that? How do we compare that? Now we come here to see if we received any dividends. I will go here there. Where is the section? Cash flow from investing activities. Now, dividends received section. I want us to see, did we receive any dividends or not? Now, we start with the opening balance of the dividends, our interest, our share in this subsidiary, not subsidiary, but an associate. Joint venture. Where is the joint venture? It is here. So the opening balance is 290. Remember, it is an asset, right? It is an asset. We are following on the movement of our ownership in it compared to what we received as a share of profit. If the value of what we own went up, then it means there was some profits made. If there was that profit made, we compare with what we received. Now, out of what is made, how much did we receive? That's what we are looking at. And to know how much we received, whether there was any dividends in it or not, we check with the income statement our share of that profit. So I would go ahead and pick the opening balance, which I've picked. After I've picked the opening balance, I want to compare that. With what we received from this joint venture. Where do we get it? Share of joint venture profit. Because it should actually increase our ownership. It will increase our ownership, which we recognize as our asset. So I will go ahead and pick the opening balance, then add what did we receive from this investment, and what we received is 240. After that, I want us to compare if this is what we are closing with in our books as the value that we own in this joint venture. And what value are we comparing it with? We are comparing it with the closing balance. Where do we get it? Statement of financial position, and it is 400. We compare with that closing balance of 400. If I confirm, I can see that there was a dividend received of 130. We opened with this amount. Of 290. We add the amount received as the share of our profit. Then we compare that with the amount closing that account. Because if we add what we received, that totals up to what we expect to have at the end of the year. Now we compare with actually what we have at the end of the year. We are following the trend of opening, adjust, compare with closing. Opening, adjust, compare with closing. Opening amount, the adjustment here is what we received, the share which we received, which would actually increase our opening. We compare with closing. And there we have a dividend received of 130. There you go. So after dividend received, investment income. Did we have any investment income? In the income statement, let's see if there was any investment income. There was no investment income recognized there. There was no investment income. So that I think those are all the elements we have under investing activities. So we just come and get the net cash flow from investing activities. The net cash flow from investing activities like that. And that is the net cash flow. I push it to this other end like that. Good. Those are the net cash flow from investing activities. Then we go to the final part, cash flow from financing activities. What are these cash flows? For example, these are modes of raising finances. Did we pay any dividends? Did we issue any shares? Did we acquire any loans? Or did we pay back any loans? These elements, I believe you are well aware of them. And now let's narrow down and see. How do we know if shares was issued? How do we know if shares was issued? I want also to give you a very easy approach to get to know the amount of shares that were issued. It is very simple. Now, for you to know the amount of shares that were issued, take the opening balance. And I want us to treat this, because I'm avoiding T accounts. I would want us to treat, so for us to get the issue of shares, the amount of shares issued, we should treat it as a liability where we start with the closing, but I think that approach might confuse somebody. So let's just start with opening balance. Opening balance in that share capital account, we are talking about share capital. Then this opening balance, if you look at our statement of financial position under ordinary share capital, remember, ordinary share capital goes hand in hand with share premium, because it is issuing of shares where you issue at par or at a premium. So we have to treat them together, the same way we treated current tax and deferred tax together. So I'm introducing a bracket and telling you, reminding you that make sure you add ordinary share capital, make sure you recognize that, plus premium, share premium, because they go together as an opening balance. Then onto that, you are going to recognize any issue of shares. And the issue, we have two issues. There is an issue at par, and then there is a premium on issue. Because it is increasing our share capital account. Then all of that, you are going to compare all of that with the closing balance. Compare with the closing balance of the ordinary share capital account. Compare that with the closing balance of the ordinary share capital account to see if there was any issue, of shares. I just want to hope that this one is not confusing someone. So let's go and do the computation so that you see how easy it is. So I would go to that cell there and start with the opening balances. Where do we get the opening balances? Statement of financial position. And I'm telling you, we are adding both ordinary share capital and share premium accounts. So let's go and pick it. Under equity and liabilities. So the opening amount is 2,000 for ordinary share capital. We are adding the share premium, which is there. I'm seeing 200. Then onto it, we are doing adjustments of the opening balances. The adjustments that we do for the opening balances, we go to the issue of shares. How much shares were issued? We've already done that computations. When we were doing goodwill, you realized we issued at a premium of 100 and at par of 500, right? So I will come here and add the new issue at par. I've referred to the 500. Then again, I'm recognizing the premium on issue of how much? 100. After I've done that, have done all the adjustments on that opening balance, because share amount, ordinary share capital account, is affected by either new issue, rights issue, or bonus issue. Either you are issuing at par, at premium, rights issue, or bonus issue. Those are the elements affecting our ordinary share capital account. All this I'm comparing with the closing balance. I'm comparing that with the closing balance. And actually, I want to start with the closing balance because I told you we are treating ordinary share capital account. We are treating it as a liability account because it is under shares and liabilities. Yeah, shareholders' equity. So we are picking the closing balances. Closing balances in the statement of financial position, where are they? 4,000 under ordinary share capital, and it goes hand in hand with the share premium closing balance, like that. We are comparing the two, like that. So if I get the difference, opening plus adjustments should give us the actual closing balance, but the actual closing balance was given. So let's get to see the difference. There you go. 1,600 is the amount of shares that we issued. 1,600. And when you issue shares, it is an inflow. 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 Diana is saying repeat. Now, Diana, I want you to do this. Let me remove this closing here.
Mwalimu,
Yes?
me got lost from afar. I got lost from process on this
Okay.
because of PPA.
I'm repeating issue of shares. Now, how do you get to know when shares were issued or not? The amount realized when you issue shares. I've just said here very simple. Let me just remove these closings. Take the opening balance of the share capital account and the opening balance in the share capital account. Let me as well just do away with everything here. I'm picking the opening balance of the share capital account and the opening balance is 2,000. And I'm also adding onto it the opening balance of a share premium. Then onto that, I want to ask myself if there was any issue of shares. And the answer is yes. There was an acquisition in Note 1, and in that acquisition, we also did a share exchange. And we've already done that computation in our goodwill computation here. You see the share exchange. So it means we brought on board more share capital. And it was in two parts. There was that part we issued at par. I'm adding the 500. You see it here. We already computed it. And we also issued our shares at a premium. What was the premium on issue? It is 100. Those are all the adjustments that we need to consider in ordinary share capital account adjustments. So if I confirm at that point, this is the amount we expect. You see this 2,800. This is the closing balance we expect in that share capital account. But is this really the closing balance? Let's check the statement of financial position. The closing balance is 4,000 plus 400. So what has happened? What has happened? If we are closing with an amount that is more than the amount we expect that account to end or to close at 2,800, but it is closing at 4,400. What has happened? We must have issued more shares. And if we issue more shares, that is money coming in. We are raising capital. That's why that opening plus those adjustments, we are comparing. If we expected to close with that amount, but the actual amount we are closing with is the 4,000 plus 400, which has been given in the statement of financial position, like that. And it is the 4,000 under ordinary share capital and 400 under share premium. You see them here. This is the closing balance we are comparing with. And that gives us the amount of shares, the amount received from the issue of shares, which is 1,600. Now, let's look at the next element. Was there any dividends paid to the non-controlling interests? Was there any interest paid to the non-controlling interests? How do we get to know that? How do we get to know if there was any interest paid to the non-controlling interest? I want us to go to the statement of financial position. Under NCI, I want you to look at the line of NCI. NCI, and I can see non-controlling interests here. You see the NCI line? Good. We want to see this movement in the NCI account. And the movement in the NCI account, we are going to start by we are treating all this as liabilities. It is closing minus opening, but opening must have adjustments. What is the closing? The closing balance in NCI account is 2160. You see it. Opening balance in the NCI account is what? 1800. Now, it is this opening balance that we are going to do adjustments. We are going to do adjustments. And the adjustments we are going to do depends on the factors that have affected this account. So let's just start with the closing, then opening, and we adjust that opening. We see what we are adjusting it with. And we see the difference in that account balances. So we come here. We want to find out if there were any dividends we paid to the NCI. Any dividends that we paid to NCI. So we come here, we start with the opening balance. If we opened our NCI account, where is it? We opened it with 3480, right? We opened it with 3480. Then, no, it is not 3480. It is 1800, yes. We opened with 1800. Then, what do you think has increased or has affected our NCI account? I want you to look at the computation of goodwill, if there is something that affects our NCI, but most importantly, I want you to look at the section in the income statement where there is appropriation. There was an appropriation that was done in the income statement. I want you to look at it. There was an appropriation done from OCI coming all the way. From OCI coming all the way. I want you to look at total comprehensive income section, there was that income which was attributable to NCI. There was that appropriation to NCI. Are you seeing it? Attributable to the non-controlling interest. They were paid how much? They were paid 20 million. That 20 million is adding onto the value or increasing the account of NCI. So we are coming and adding that 20. That is a share of profit that they were given. Then what else? I want someone to tell us, what else do you think is affecting our NCI account? What else is affecting our NCI account? Somebody? What else do you think is affecting our NCI account? Someone should be able to see it very fast. Someone should be able to see it. I want us to finish before time ends. Becky, what are you saying I've ignored? I think we've been moving together.
No, Mwalimu, I chatted you at the point when I got lost, you didn't answer. Then when I've told you repeat again, you have ignored me.
I think I've just repeated on this share capital. I think that's where you were asking a question, and I've repeated on how we are getting the amount realized on issue of shares.
No, it was at the point of disposal of PPE. But you can share your workbook after this. I will follow through.
PPE we did quite some time back because PPE was under investing activities, and I hope that
Yes, when I got lost at that point is when I raised it on the chat box, but I think you didn't see it, so I'm just requesting you share the workbook after
sorry, you
this.
could have just asked. Sometimes, you know, a lot, these charts are a lot, and I might not be able to see all of them. You should just, you know, raise up your hand or you just unmute and ask if I don't see it so that you don't remain behind. But
It's all
good.
right.
Okay. So, what other elements affects our NCI account? We've already considered the amount attributable and shared to the NCI. What else? What else? Somebody, what else? Somebody, I want us to finish. Somebody? What do you think affects NCI account? We've picked on the opening balance. We've adjusted it by recognizing the share of the total comprehensive income that they get. The share of the total comprehensive income that they get. What else? What else affects the value of NCI? NCI at acquisition, portion of net assets, okay. TMK profit we've already picked, so I'm looking at these two members saying NCI, impairment, Someone is saying impairment. So let's look at this computation of goodwill. Let's look at this computation of goodwill. Now, this computation of goodwill is giving us the fair value of NCI at acquisition. Now, at acquisition, we acquired NCI at 340, right? Now, if that was the fair value of NCI which we acquired, and remember in our books, we have an opening balance of NCI. So onto that opening, we add the share of profit that we are getting from NCI. Then again, we make sure we recognize the fair value of NCI which we acquired. At acquisition, we acquired 340. You see it there in the computation of goodwill. That is the fair value of NCI at the date of acquisition. And once we've picked at the fair value of NCI at the date of acquisition, remember, we are looking at the NCI account only. NCI account only. The fair value of NCI at acquisition was 340. The share of income or the share of profit, which they shared, the comprehensive income, is 20. We've already recognized that. All those will adjust our opening balance. And if I confirm, this amount which you see here, 2160, this should be the closing balance in the NCI account. But is it the closing balance? I want us to check the closing balance in NCI account, which has been given in our statement of financial position. You see, NCI is closing at 2160. But what is our adjustment saying? Our adjustment is also saying that we should be able to close at 2160. So if we have adjusted our opening and we are getting 2160, and that same amount is what is closing that account, then it means there was no dividends paid. So if we compare that with the closing balance in this NCI account, let me just refer to it. the closing balance is 2160. If we compare that with the opening plus the adjustments, you realize there was no dividends paid because the net effect is zero. So there was no dividends. That's how we determine the movements in the NCI account. Then we check if there were any dividends paid to our majority shareholders. We've checked on the minority. Let's see, did we have any dividends paid to the parent shareholders? The answer is yes. Let's go to the income statement and look at the appropriation section. In the appropriation section, we see there was that attributable to owners and there was attributable to NCI. So we are in the owners now. How do we get to see if what we paid to our majority shareholders? We must go and see, ask ourselves, where do we normally pay dividends from? Where do we pay dividends from? We pay dividends from the retained earnings. So let's go to the statement of financial position. The same way we've checked on the movement in NCI account is the same way we are checking on the movement in our retained earnings. If you opened your retained earnings by 1170, then you've added your profit for the year, your profit after tax, which you received. It is given here. You see the profit for the year, this is what you received. Then, with what you received, you compare that with the closing balance in the retained earnings account. The retained earnings in the closing balance for the current year. But remember, when picking the profit for the year, we are only picking profit for the year which is attributable to owners of the parent. We are not picking this profit for the year for the whole group. No. Remember, this is a group account. There is NCI, minority, and there is majority shareholders. So we must make sure we separate the two. Now, let's do those adjustments as we understand which profit we pick. Where were we? Here. Now, we want to look at this, whether we paid dividends or not. And we are checking on the movements in the retained earnings account. So let's go to retained earnings. In the retained earnings account, let's see how was it affected. Opening balance was 1170, that one. Onto that opening balance, what increases our opening balance in retained earnings is profit for the year. But remember, we are dealing with group accounts. We are not going to pick the total profit for the year for the group. We are picking profit for the year which is attributable to the parent shareholders. Where is it? It is this one. You see profit for the year. Below it, there is attributable to owners and attributable to NCI. So this is what we are picking, attributable to owners. Now, that one will give us what we expect to close the retained earnings account. So if I confirm it, let's see what is there. 1610. This is what we expect to close the retained earnings account. So let's see, if the retained earnings account is having less than this, then we must have paid dividends. So let's go to the retained earnings. We expect it to be 1610, but is it 1610? Let's see. Retained earnings, I can see it is 1240. You see that? So it means we must have paid dividends. We expected 1810, but we have 1240. What has happened? That difference is we must have paid dividends on it. So where was it? Here. It is 1610, but the actual closing balance, which we have here, let me just pick it, it is 1240. So if we have 1240 and we expected to have this 1610, what has happened? We must have paid dividends of what? Of 370 to our parent shareholders, like that. Acquisition of loans. Where do we know if we have acquisition of loans? We check on our long-term liability section. You see what movements in loans. In addition, information number 1 on acquisition of the subsidiary.
Mwalimu, repeat on dividend paid.
Dividends paid, I've said we only look at the movements in the retained earnings because we pay dividends from retained earnings. Now, check the movements in retained earnings. The opening, and remember, retained earnings is affected by profit for the year. But when you come to profits for the year, where is retained earnings? It is here. Now, our opening retained earnings is 1170. You see that? 1170. What affects it is profit for the year or profit after tax. Remember statement of changes in equity? Yes. Now, we are adding profit for the year to the opening balance. And profit for the year, which we are adding here, remember we're dealing with group accounts. So we are not going to add the total profit for the year for the group. No. We are looking at the amounts we paid to the parent shareholders. So, because you know a group has both parent and subsidiary, we are done with the subsidiary. So let's go to the parent. Under profit for the year, there is attributable to owners and attributable to NCI. So we are adding attributable to owners, right? So the opening balance of the retained earnings, 1170, we are adding the share of the profit, which is meant for the parent shareholders, for the owners. Then that should give us the amount that is closing the retained earnings account. We expect it to be 1610, but I want you to compare 1610 and what is actually closing that account. That account is being closed by 1240. What has happened? We expected it to close at 1610, but it's closing at 1240. That reduction in value in the retained earnings account represents the amount of dividends we paid to these parent shareholders, which is how much we are taking 1610, we are comparing it with 1240. We must have paid dividends of how much? 370. That's how we've gotten the 370 as dividends paid to these parent shareholders. Did you get it? I hope you've gotten it. I hope you've gotten it. I hope you have gotten it. Good. Now, acquisition of loans. I told you that one is under long-term liabilities, and it is very simple. You just check the movement in loans. You just check the movement in loans. Just check if there was an increase in the amount of loan, or if there was a decrease, then you must have paid. You must have paid the loan. So let's go to the long-term liabilities. Long-term liabilities, and I can see long-term loan is here. If you opened with 1590 and you're closing with a higher value of 2070, what has happened? In the additional information, there was no any information relating to long-term loans. So we cannot assume any other adjustments in that loan account if we are not told. So we are only left to compare the figures, the closing and the opening figures. If we opened with 90 and closed with 2070, that loan account has increased. And for loan account to increase, you must have acquired more loans. Acquiring more loans is an inflow. So an inflow is a positive. So we compare the closing balance in the long-term loan account, and we compare it with the opening. There are no adjustments to adjust that opening amount. So we just leave it at that, and we say we acquired more loans of 480, like that. I think those are all the adjustments we're supposed to do. If I check on our statement of financial position, I don't think if there is any element that is going to affect our financing activities, our financing activities. I think we've taken care of everything there. So that one gives us a net effect, net cash flows from financing activities there. And the net cash flow is 1710. I push it to the end here. That is the net cash flow. So up to this point, we have all the elements, and these are the elements that are being marked. So what we need to do is just to bring net changes in cash and cash equivalents. And the net changes is the net effect of these three categories. Yeah, the net effect of these three categories. We just pick the net cash flow from operating activities, which is here. We add the net cash flows from investing activities. Then we also add net cash flow from financing activities. That gives us net changes in cash and cash equivalent. And mine is 180. Then we bring cash and cash equivalents balance brought down. Now, this is very simple. What are the elements of cash and cash equivalent? Check if there are any notes payable. Check if there is any cash. Check if there is any bank OD, bank overdraft. Check if there are any financial assets. And those ones you check under current assets and current liabilities. So let's check out so that we get the balance brought down for cash and cash equivalent items. So let's go to the statement of financial position. I want us to finish. Time is almost out. So under current assets, elements of cash and cash equivalent here, I can see we've been given just this. So I'm picking the opening balance only. And the cash and cash equivalent is 880. Let's check on current liabilities part. Current liabilities, do we have any bank overdraft? I'm not seeing. Do we have any notes payable? No. Do we have any financial assets? Under current assets, we did not have. Current liabilities also we do not have. So that means the opening balance is 880. It remains the same. Then that gives us the closing balance in this account. And the closing balance is just net changes plus the balance brought down. And it is 1060 from here. I can see I'm getting 1060. Now, we can compare if we can confirm if 1060 is okay, is correct or not correct. How do we confirm? Go to the statement of financial position again and look at the closing balances of those. Under current assets, let's pick the cash and cash equivalent elements. Where are the current assets? Cash and cash equivalent is only one, 1060. Current liabilities, do we have any cash and cash equivalent element? No. So that means closing should be 1060. Confirm and compare, and you see that we have the same 1060 which we've gotten from our figure. So this is a confirmation that our figures, our cash flow statement is correct up to that point. So we cannot proceed past that point. Thank you and have a good day.
Let me share a workbook, please.
All right. I'll share with you.